Good morning, Jags. This is Fahad. Today is Tuesday, November 17th. Let's get started. This is a C Limited, symbol SE chart in front of me. And if you look at pre-market action after earnings came out, the stock was initially quite strong and then immediately faded. And it looks like it's going to open down about 2 to 3% after closing at 178 and pre-market is trading at 173. The low was 168. So it's trying to recover right after the conference call started, but we'll see. It's going to open flat to slightly down. But here's the most important thing. I believe there's potential for this stock to make a red to green reversal. So watch the option activity, particularly in short-term weekly call options after the market opens. Also, I believe that in the intermediate term, this whatever the gap down is going to be will not last for too long. I expect whatever the weakness we're going to see, the stock will make a U-turn from there and will potentially go to make new 52-week high. Let's see if that happens today or if it happens in the next couple of days. So keep an eye on this stock. I do not think this will stay down for too long. Just a couple points to highlight about this. If you look at today's first read, right over here, in which we gave a quick review of what the earnings look like, you will see one number that stands out, which is this revenue miss. The company reported $1.21 billion in revenues versus $1.4 billion in estimate. That seems like a pretty significant miss, right? One would think, wow, that's a more than 10% or 12%, below the consensus. But then you look around and you see the EBITDA is ridiculously strong. EBITDA turned positive to 120 million versus a 45 million decline that was expected. Digital entertainment bookings were very, very strong, and the guidance was raised for the entertainment bookings as well as for the total e-commerce. I mean, take a look at the fiscal year guidance for the revenues for the e-commerce segment to exceed 2.3 billion versus prior guidance of 1.7 to 1.8 billion. So how is it that the company is reporting revenues for Q3 that seems like a significant mess, 13, 14%, but then going on to talk about fiscal year total revenue guidance, which is going to exceed materially to 2.3 billion versus their prior guidance. That's like a 25% or something above their prior guidance. And along with it, they're also telling you that the entertainment bookings will also exceed sharply than compared to what they previously told us. Now 3.1 billion versus 1.95 billion at the prior midpoint. I think the answer over here lies simply in the mathematics or the accounting of how these revenues are actually being recognized. You see, do not believe the street estimates a $1.4 billion estimate that was for Q3 this morning, which is showing that the company is missing expectations. The estimate is actually an adjusted estimate on the street. Without going into too much details, just know that some of the gaming booking revenues were part of the total revenue estimate on the street, and versus what the management is reporting this morning is GAAP revenues, the actual revenues. And so when you actually, and this was not the case last quarter, in Q2 and 3 months ago when the company reported earnings, those were proper apple to apple comparisons, but this time they're not apple to apple comparisons. And I think that's what may have caused initial selling in the stock and is starting to now come back, potentially because management is likely clarifying this point right now as the earnings conference call started around 7:30, and you can see stock has started to come back since then. On a pure, in absolute numbers, I can point out this was a fantastic quarter. This was absolutely blowout quarter. Revenues were up 98.7% year over year. Gross profit was up 100% year over year. All right. And the bookings were up 109%. If you go across the board in every single metrics, like a per unit or per user metric, you look at the GMV growth, you look at the number of accounts or the active users, quarterly active users, for example, here, quarterly active users reached 572 million, an increase of 78% year over year. Quarterly paying users grew by 123% year over year to 65 million, which now represents 11.4% compared to 9.1% of the prior year, same quarter. Every single metric was an absolute home run for this stock. the Free Fire game continues to be the highest grossing mobile game in Latin America and Southeast Asia in the third quarter. And so, very, very impressive quarter in absolute terms in every single metric. And so I believe that the top line revenue miss is simply the function of how the company is reporting GAAP revenues, and it's being compared on the street to what is adjusted revenues, adjusted for the bookings on the gaming side. So I don't think it's a proper apple to apple comparison. So that's the only reason. So let's see if this thing is going to turn around, make a U-turn, and finish on the green today. And if it's not today, I think this will happen in the next couple days. And then secondly, quickly, that I would like to touch is Walgreens is going to gap down sharply. It's down more than 10% in pre-market after the news came out that Amazon is going to be launching an online pharmacy. We'll see exactly how the stock will react and how this will settle down, but I expect that this pullback in Walgreens is also presenting, and same thing with CVS too. I believe this pullback in both of these stocks is presenting yet another buying opportunity. Amazon is not going to have a very easy entry into online pharmacy. They tried this actually a couple years ago, but they dropped the plans. But then the reason simply is because it's not as easy buying prescription online as, let's say, buying your pet food or something, simply for the reason that there's you have to run the claim through the insurance company. You have to know exactly what the deductibles are. There's a human element that's involved over here trying to figure out exactly what the right price of prescription should be. It's not the same price for everybody. It's not like, again, like buying pet food or, I don't know, your golfing equipment or anything else on Amazon, and everybody pays the same price. It's different for every single person because everybody has different kinds of insurance. And most importantly, the prices are constantly changing up and down in the prescription billings and such. And separately, there's also a fair amount of financing that is also involved in the prescription billing. Many people defer the payments. Then there's an issue that needs to be resolved about how much is Medicare and the Medicaid is picking up in terms of the total cost of prescription. And so this is not as simple as just buying anything online. There's a lot of elements that's involved over here. And that's why despite being a leader in the e-commerce, it has been very, very difficult for Amazon to break into the prescription billings and prescription e-commerce for many, many years. They are entering into this space, no question about it. But I think a 10% sell-off in both of these companies, Walgreens and CVS, is a bit too much, and I expect both of these stocks to bounce back from this weakness and look for Walgreens to return back to mid-40s over the course of next couple of weeks or so and basically recoup this entire loss. I will quickly point out, just reiterate my view that I said last week, which is this company is going to benefit with both Moderna and Pfizer vaccines coming out. They need a distribution mechanism, and JP Morgan and Morgan Stanley, both of them have been out recently talking about that the sales will potentially, for the COVID-19 vaccine, will potentially add as much as 300 to 400 basis points of total same-store sales growth to both of these companies. That's a view that still needs to play out because these vaccines are still coming out in the weeks ahead. So look for this as a buying opportunity in both Walgreens and CVS. All right, that's it from me. Jay.
Morning, everyone. Today, looking at symbol UTZ, Utz Brands. This is a consumer play, a snacking company. Company actually debuted at the beginning of September through a merger with a SPAC, specifically Collier Creek Holdings. So first off, last Friday, there was some unusual option activity, specifically in the April 20 calls, I think going for a $1.65 offer. And this was something that you've had mentioned. Obviously we don't catch everything, during the market hours. So there are times when at night or over the weekend, we kind of point out something internally. Now, going back to November 5th, this was their debut earnings, their Q3 earnings report. Just very quickly, net sales were up 24%. And that did include a bunch of acquisitions. So when you strip all that out, net sales were up 7%. Now, sales in their track channels grew 13% in the 13-week period ending September 27th, and that was ahead of the salty snack category, showing growth of 9%. So overall, their power brand segment was up 15%, and their foundation brands was up 5%. Now, about a week and a half later, on November 12th, the company announced an acquisition. It was acquiring Truco Enterprises for $480 million. Truco operates the On the Border brand, or OTB. OTB sells tortilla chips, salsa, queso dip, that sort of thing, those sort of items. Now, following that announcement, you had D.A. Davidson, Oppenheimer, Credit Suisse all out with notes. Piper Sandler was also out, and they upgraded the stock to overweight from neutral, saying the acquisition of OTB adds scale to Utz's tortilla chips business and helps fill a void in its portfolio. Tortilla chips are about 22% of the salty snack category, and Utz only has a 0.3% share of tortilla chips. So as you can see, it's going to help them grow tremendously. On the Border is strong in both club and mass channels. Credit Suisse notes that 40% of sales come from Walmart and 20% of sales come from Sam's Club. And Utz is going to so Utz is currently under-indexed in these categories. So using OTB's relationships, it'll be able to expand the distribution there. And the last thing that Piper points out is completely separately, but a deal in the popcorn subcategory could also be on the horizon eventually, as Utz only has a 1.4% share in that category. So overall, quarter was good. Net sales were up, and now they're starting to expand into other subcategories, which should propel their growth even higher.
Interesting stuff. What we noticed last week was I saw there was a steady accumulation in this April 20 call options, more than 2,000 open interest in this now, and they have been gradually accumulating this for a couple of days. But there was one day last week when they were just buying this, and we saw this too late after the market had closed. So I brought it up in an internal chat. But then I looked further, and I also saw that way out of money, way deep in the money and longer term, December 2021, 12.5 strike calls. There's open interest of 1,700 here. Previously, they have been accumulating this position as well. So for the 2021 period, there have been quite a bit of bullish positioning in this stock, and it's a fresh new IPO that came in September. It looks like that the growth market for these guys, based on this discussion, is going to be this acquisition that they announced, plus the tortilla chips business. I mean, I don't know exactly how big the category is, but 22% of sales, if I heard you correctly, is
correct.
Right? I mean,
Correct.
And it's a growth segment for them. So I was just looking at their website. Pretty interesting stuff over here. And so we got to monitor this one, because this will also trade positively with an overall improvement in rotation into the staples sector. If you see staples generally outperforming, then I think this could also run. Chart is starting to break out. It's now actually at post IPO high, 2 months after the IPO. So the trend is also starting to improve. Got to watch this one. And who knows, this is the kind of a name that could become a very easy tuck-in acquisition target sometime, in the long run. Happens quite frequently when these small companies show up with high growth potential, and then before they get too big in the salty snack business, they basically get bought out by the larger rival firms. I've seen this many times. So, all right, good stuff. We'll keep an eye on this one. Chronicle.
Morning, Fahad. Nothing substantial today. First off, just a reminder that the Ergo presentation is going to be out sometime this week. I know you're looking forward to this one, Fahad.
Yeah.
Second of all, Barclays was out with a wide coverage on property and casualty insurance companies this morning. If we look at the note, their main point is that these insurers are at the winning end of a pandemic-induced recession. So COVID-19 has been spurring much needed, in their words, foundational underwriting improvements that extend beyond the purview of a hard pricing cycle. So that's the main point that they made. But I think the other point that they've missed out on is so I've been long a Japanese insurance company called Tokyo Marine for several months now. Symbol for that is 8766. And basically, in their latest earnings report, we can see that they raised their guidance for 2020 by a mile, and it's going to beat 2019 numbers by 4 times. And the reason for that is because for auto insurance losses and accidents, they've been happening less frequently in the pandemic. So because of less accidents, there's fewer write-offs, and so that's going to result in multi-year earnings records. So I'm wondering if the American companies are going to see something similar on their end as well. So this combined with Barclays note, I think this is something to watch. I still have to take another deeper look at the Barclays note, but looking at charts, I'm noticing that several of these insurers have broken out from their bases. AFG is the first one, Y is the second one, and ARGO is the third one.
Yeah, I recently in webinar, I believe this was about 3 weeks ago in webinar, I actually presented a bull case for Chubb, symbol CB, and we recommended buying call options to the clients that were interested in getting an exposure to the insurance sector, and CB was my favorite way of playing that. This was when I saw a power candle breakout and the stock started to clear through all of this downtrending resistance. Usually, as I say this all the time, that any time when something is going to break out on heavy volume through key resistance, that's just the beginning of more higher highs and higher lows to come. And that's exactly what we saw. Since then, the stock CB has appreciated from 125 to 151 over the course of just past 3 weeks. Getting a bit extended over here, RSI has started to flatline as well. MACD will likely also start to show some decelerating trends over here. And this also happens to be my upper end of the channel resistance, of VOP resistance of 151. So that's really the only one that in the insurance space that I've covered recently with a bullish view. And but overall, I agree with you. I think there are some positive things to take away on the insurance sector, simply for the fact that they're not like the banks that are hurt so badly with the net interest margin declines. And I think that when the value sector continues to outperform, insurance companies are always the first one to see within the financial sector to see the positive flows before it starts to trickle down towards more traditional banking sector. And so I think this is generally responding to improving economy, as well as more or less the actual flows being positive into the sector. And if you're seeing in Asia and in Japan as well, that's likely to continue to trickle down in the US as well. So I agree with that view. Probably worth a sector that's worth investigating more. I will also mention that PGR, Progressive Corp, has been our favorite play for a long time. A couple of years ago, in fact, we presented this as a top pick in the Jaguar quarterly outlook. Who would have thought that we would come with an insurance company as a top pick, but we did, and this thing performed remarkably since then. And so sitting near 52-week high over here already. All right, good stuff. If you find any more information on this or take any more specific interest in one or two insurance companies, looking forward to see what you can discover. All right, guys, we're going to stop over here quickly. C Limited, pullback is a buying opportunity, and Walgreens, pullback is a buying opportunity. That's it from me. I'll see you in the chat room shortly.